Welcome to Distilled Insights, everybody. This is episode number 4. We're talking about financials today and relating to audit, relating to how good they should look, how to make sure they look good, where people make a lot of mistakes and do things wrong, particularly for the larger businesses, and probably where the smaller businesses go completely wrong because they're not actually preparing a P&L or any kind of performance reporting in the right way, shape or form to properly be able to decide what's going on with their business. So quite a long and pretty big topic we can go into, obviously from the investor side, from the accounting side, but it's going to be quite interesting, I think.
Well, we can make it pretty dry and boring, but I'm pretty sure no one would watch it.
Well, to be fair, the content is probably actually pretty boring, but we're such dashing lads, right, with such huge personalities, right, that of course anyone would want to watch it.
The whiskey today, the Dalmore Portwood. Reserve. No, did I start?
Yeah.
Okay. I'd like to say sponsored by, but sadly no. They'll get back to us, they said. Either way,
Thanks, Dalmore.
Beautiful number, but big hint of port on there. Frank?
Did you get that from the title or from?
Well, classically, I'm clearly experienced in.
Let's see. The aroma: sweet red berries, Seville oranges, plummy fruits, and sticky toffee pudding. On the aroma.
I only got one orange, not multiple.
Well, maybe you've got one side of your nostril blocked. On the palate, nectarines, creamy caramel, roasted chestnuts, and Java coffee. Finishing notes: rich plums again, sultanas, sanguinello blood oranges, and macerated cherries.
Yep, exactly.
I liked it all except the last one.
I got none of that. Just going to throw it out.
Well, I didn't get any on the palate, so that's why I'm still drinking it, because it's delicious, quite frankly.
Also, I haven't had taste for the last 3 days, so this is just livening up the old senses after this.
Oh, sorry, it was the flu.
Which is very different.
That's
much worse.
That's what it's purely in your head.
It's a serious thing, and women out there should recognise how bad it really is. Don't go down this path.
Don't like and subscribe.
Yeah.
The opinions of the individuals on this podcast are purely their own. No wave joke in the form of
do no way endorse the actual feelings of Alderton Bhudia.
Great. We're going for lawsuits.
Yep.
Brilliant.
Yep.
All right, let's get on to it.
Let's talk about numbers. Let's get sexy immediately. Start talking about financials.
Well, it's literally all I do. Look at reports, peer through reports, look at company financials. Because how else am I going to know how business is doing and whether to invest in it? But by looking straight at financial reports and pulling them apart to make sure that things are going in the right direction. So it's wildly critical for someone in my position that these are accurate. Because if this is a trust game, you're trusting in the fact that the company is reporting appropriately, that the auditors are picking up any errors, omissions or anything like that and adjusting accordingly, and you hope that the governing bodies are also doing their part behind the scenes, because otherwise, without the trust, then the whole investment thesis breaks down.
How often do you find questionable stuff? Because this is all STEM. I mean, right now here we're in August, right, about to be September. It's basically audit season / reporting season for end of financial year for all the listed companies. Less so crucial in terms of timeline for smaller businesses, but in reality, if you want to actually have a good grasp of your business, whatever size it is, right, you should have already wrapped up at least management accounts for your end of financial year long ago, so you've got decisions to make in the new year, right, even though that should have happened throughout the year, of course. But right now you're going through a big audit process. Right, there's lots of things you've got to do, lots of notes you've got to provide to shareholders, lots of disclosures, lots of all of this stuff. But what do you find? Do you ever find stuff that you blatantly think looks way out of whack? Or...
Look, once again, no, and I think it's pretty hard to spot something that I would say is blatant. Talk about full-on fraud here. It's fraudulent, it's generally easily masked.
Yeah.
Up to trusting in the audit team to do their job to be able to verify and pick it up. As an investor, we're not going into the companies that we're investing in and ticking and bashing, as we say in the old audit game, in order to find whether these things accurately match up. That's not our skill. We're not giving enough detail in order to be able to do that, nor the access. So you do rely on your audit team in order to verify that this is correct. Obviously, some of the biggest frauds in the history of the stock markets are certainly well known, a couple of them, Enron being one of them.
Yeah.
Once again, generally the investor that will pick up on it would be people in the know that have access to some pertinent information. But in terms of what I'd call probably less fraudulent, which is a bit more massaging the numbers in order to make certain things look good. that's something that can be spotted. So if you gain familiarity with a business, you'll see trends, you'll be able to pick up within the figures. This is subtle stuff that we're talking about, so it's not a big red arrow pointing to look at this line. It is stuff which you need to do your homework on before you start seeing issues.
And so, how accurate, really? Because obviously, you go through your audits, right? You've got your accountants, you've got your tax portion, you've got your accounting portion, you've got the auditors doing their job, you've got your internal management, controls and mechanisms and all this sort of stuff. But how accurate, really, are financials at the end of financial year? The auditor can't pick up everything. And we know for certain, right, in today's world of business, that there's a huge emphasis of, well, we have to find a way to not put this in because it's going to erode shareholder value, right? And therefore, massaged, as you've said, possibly not illegally, right? But certainly, like, it's pushed as far as it can be to make sure that it doesn't affect share price.
But there's also the word that comes up many times, which is what is brushed under the carpet.
Yeah. And what is materiality to an investor versus what we have as materiality when we're closing out an end of month or end of financial year or something? Our materiality might be very different to what you're looking at. Like, we look at revenue recognition, for example, right? You're talking about, okay, well, when do we mark revenue? When do we recognize revenue based on the business? And I think, and we're talking obviously about bigger levels here and revenue recognition and how the accounting standard works and when we should be doing it, right? But this is also important for smaller businesses because how do you actually, like, your weekly, monthly, quarterly, annual business if the revenue is not right? If you just blatantly throw stuff in revenue, invoice out, no matter whether it's actually a service that's been delivered or a contract that is been fulfilled or cash that's been received, like, if you don't recognize revenue properly across the whole year, then you really don't know how well your business is actually performing.
Yeah, you're 100% right. You can only trick the investor community for so long before, once again, over a trend, you pick up how they account for it. They're pushing the envelope in order to look good one quarter versus another. It comes out in the wash eventually, and then they get punished for it if they are doing it blatantly. In terms of materiality, from an investor point of view, we're more trend focused per se. Obviously, there's a lot of talk about hitting the targets that are assigned to it by whomever, wherever, the market in general, the investor community, and we're obviously talking about big investment houses themselves. So they'll come out with a set of figures that they'll determine based upon conversations with the company management team, with what they're expecting trends and growth to be, and we'll benchmark the business against how they go against it. Obviously, those guys tend to a little bit more short-termism kind of focused in regards to those sorts of things. Me as a long-term investor can look past that a little bit more. So my materiality level is generally a lot, I think it's the right way of saying it, rather than someone who's in the compliance space, like an auditor, like governing bodies, that would be like, well, you need to adhere to the accounting standards based upon X, Y, Z. So, yeah.
Yeah, yes, I suppose it depends on the business size as well, right? So, like, you think about if you're investing in a small cap or recently listed or an IPO or something like that, generally speaking, there's some history there, but you're really investing in the future, right? So the scrutiny and the materiality you put in other businesses is probably less than if you're buying something that's $bucks a share, $50 a share on the ASX, because presumably that comes with some consistency.
Okay, let's just pick that apart a little bit. So in terms of dollar values on share price, kind of a red herring that a lot of people get sidetracked on. Like, no matter if something's worth $40 or $100 or 2 cents, the price is technically irrelevant. It's more what it marries up to its value. I mean, you have a company that has $100 billion worth of market cap, but it might have 100 billion shares and worth, diddly price per share.
Yeah, no, fair enough.
So again, like, it's still a massive company at 100 billion. I mean, there's one here in WA that's hit that mark. So yeah, one of those things where it's more relative to the share count that you get share price, and some people get confused about that. I mean, it's easier to see 2 cents go to 4 cents and W money rather than $20 going to $40, but it doesn't mean that it can't happen in the same fashion just because there's a lesser count. I mean, the only thing in that scenario would be getting the shares would be a lot harder because there's a lesser quantum. So I just wanted to park that one just for a moment because that's the only thing I picked up on that there. But in terms of what you're doing, in terms of your materiality, how much you're assigning, and that's the key, I think, word in this one is risk. Is that yes, with less information comes more uncertainty, which is equal to more risk. More uncertainty generally provides more upside, the potential for more upside, because the more certainty, the more that the share price has already baked that upside in. So that's probably key between say an IPO business or a private equity business versus going into the public markets, which things are a lot more stable and known.
Yep, no, fair enough.
So do you think there's more trust, I guess, in a with a more established company as opposed to an IPO where it's at 2 cents or something? Yourself as an investor.
God, yeah. I trust in the track record and the history of the company. It's there. You've got a lot more people analysing these in the big investment houses, and obviously all competing in the market share for gaining investors' eyes to help steer them in the right direction. They want us as clients. So there's a lot of information out about those bigger clients versus this town, because not a lot of coverage is presented. They're generally not on the indexes at that stage because obviously they're way too small. So more due diligence on behalf of the individual rather than trusting in the big investment analysts.
I mean, there's probably more ability to manipulate the people level because you've got more data. There's probably less able to play around too much. And I could be way off the mark here, but in all businesses that we look at and things like that, if you look at all the previous, eruptions or losses of market share or share anything like that, there's some massive ones that seem to have got through the cracks. In the or say contract revenue properly. I think it was a Kodak, maybe it was a Kodak or something like that. I'll check my notes. No, not Kodak. I think, here's a good example here. Toshiba, right? Profits by recognizing revenue early on long-term projects. So they booked 3 years of subscription revenue upfront instead of spreading it over 3 years. So my goodness, right? So, into revenue recognition, clearly that's wrong. Like, how would that pass, or an auditor?
Well,
just because you don't have access to the full detail, obviously.
And that's where you're trusting on your auditors to make sure that they're doing the work, which in that situation, that's a big one. That's like, how did that get missed?
That's what I mean. Obviously, let a contract to deliver a service over 12 months. It could be a SaaS business like that, or it could be something similar, right? And you could recognise the revenue over 11, right? And then, not as a smart idea that we would endorse or anything like that, but then you're increasing the short-term revenue by, you think that is easier to kind of, why would you take a 3-year contract and bring it back into upfront, recognising it upfront?
Well,
but the same thing would apply. It would be the value of the contract. Is it small in the grand scheme of things? So therefore, it has got washed through the material side of things on an auditor point of view. Second thing could possibly be skill set. So whoever was either processing the accounts or doing the audit didn't have the skill set to actually see what's going on.
Yeah, well, once again, I think all things come out in the wash. Something like that, you'd have a very inflated figure coming in 1 year when the revenue is recognised. And then you follow it up in the consequent years, and if they haven't, in a sense, kept the Ponzi scheme going by getting a whole swathe of new contracts to bring forward as well, then it's going to show up with a dearth of revenue in that next. Double revenue from one period to another is clear and utter fraud. And if the auditors aren't doing their job and picking up on that, then I hope their PI is massive because they will be out of business. But I certainly haven't been aware of anything of that kind of grand scale happening. Say that things don't get done. Get at the bigger end of town, there's so much scrutiny passed over these businesses that something of the double accounting nature would be very hard to get through.
No, absolutely. But it's obviously they're talking about it from the two extremes. They're not doing it no business is doing it with 100% of contracts because they get caught out straight away. It's obviously people are being selective and hoping that stuff gets missed through the sample data that gets, signatures and things like that. And if it does, then kind of happy day. It's impossible. Now we're talking about statistics, right? When you talk about, a good example might be like, how to do a stock take, right? You can't do a stock take at Amazon by actually counting all the stock, right? Because there'd just be hundreds of counting all every day, all year.
Wow.
Right.
You get onto a technological solution on those ones, and obviously they've got finances and the capability of implementing systems like that.
But I dare it's virtually impossible, and they would be, having a mathematical breakdown here.
I mean, like technology is getting to the point that having the ability to follow up on where your inventory is at any point in time is actually becoming an ability to implement.
Yeah.
And now, once again, I'm not going to say it's at the smaller end of town, because to implement software and hardware that in order to follow everything is pretty hard. But I think a way that we used to do it when I was an auditor, actually going through an inventory line and making that part of the audit and doing a verification exercise, that's probably going to become more reliant on the software side of things than the human element. I mean, you can go through and go, okay, well, you've got widgets here, let's go see. Great. If that one ticks off, we'll do maybe one more and then move on and say that the software is rolling through appropriately as need be. But, I mean, the main thing you're always looking for is, where's an issue, where's a crack? Okay, I found an issue here, let's delve further into it. I mean, that's generally how most audits proceed. But, go on off a little bit on that one.
But so we'll dig into some other stuff in a second. But as a final piece, knowing that there'd be very few sets of things that are 100% accurate, because the auditors can't pick up everything, and there's always human error, and there's always little issues that pop up and happen in all businesses and things like that. So then the question is, how?
I'm sure you guys are seeing it yourselves.
We've never made a mistake.
Doesn't happen.
No. Our financials are
And a word from our
spotless.
soon-to-be sponsor.
Spotless.
100% accurate.
Dalmore.
Please drink.
Responsibly.
Yes.
Drink responsibly. Drink responsibly. And not on a work day.
Otherwise,
Monday.
we'll.
But how deep you dig? Or does that depend on the size of the investment from your side, or does it depend on the company? Does it depend on the industry at any point in time? Because there might be tech up or medical up and agriculture. How do you pick and choose where to spend most of your energy when finding?
I think you're almost applying a very different idea set onto how an investor would look at things. I mean, every way of going about what they do, and I'm not going to pretend that I've got the answer to everyone, because that's clearly not true. But I think we're talking in the concept of accounting and auditing and looking at sure that these companies are doing the right thing by the governing agencies, all the rest of that kind of stuff. Then there's a very strict set of guidelines within the accounting standards. So I think that's where the standard needs to be set, is based there. Obviously, people like myself, there's less of a want for absolutely 100% perfect accounts. We get a little bit more tolerance in the numbers.
But also, we're talking about materiality, like you said before, man. It's like, well,
but once again,
getting from good quality accounts to absolute perfection accounts, the time it takes to make sure that happens versus the upside and the benefit of it. Is why we have materiality in the first place.
But there is no way that you can be 100% perfect and make it cost effective. It's just a fool's errand.
Yeah.
So especially from, like I said, from the investor point, we accept that there's be some element within the numbers that might not be 100% accurate. If that's a rounding error in the whole scheme of things, then so be it. If so long as the business is heading in the direction that we think it is, that it's doing the right things, that it's building upon, so long as those numbers are not skewed to the point of making your decision on whether to invest or not untenable, that's the.
From your side, what do you reckon from your clients? So moving away from the big companies, how good should financials be in our clients' businesses, to run and manage and monitor and understand? Because even from our side, we change our reporting structure all the time, right? Just because our business is changing and evolving and pivoting and moving all the time, it's hard to get right. We don't have that consistency yet that these bigger companies are, I suppose, aiming for, at least to please shareholders. So internally, how do you see it?
Well, there's two elements here. Sometimes the business owner generally isn't looking at the financials. They'll look at the high level P&Ls, balance sheets, but a lot of the time we're doing financials to appease someone else, whether that be the banks, insurance companies, whoever it may be. So we're doing it for a greater purpose. So we do see as important, but sometimes the SME market won't see as an important part of the business because they don't see the long-term benefit of it, and only becomes apparent once they do hit a brick wall, whether they need a loan or something like that. Then the banks are like, okay, these are great set of financials versus these are not good, go get them redone.
And so what number do you think they should have a better grasp on throughout the year as a business owner to understand truly their position, their model is that they're solvent? Or
So you're not talking about any external parties that may have access to the financials, you're talking about the internal of the business.
Well, probably the
itself.
majority, those external parties, whether it's investors or whether it's the bank or whether it's, anyone else that's looking will look at these numbers anyway. But if you're trying to make sure your business is on track so that you can take investment later, or that you can, what knowledge should you have that most businesses don't have at a smaller size?
Well, internally it's KPIs. I mean, it's how you're measuring your team, it's how you're motivating your team, I suppose. So you want to make sure that that information that you're getting is fair and accurate. I mean, especially according to some of your employees on the numbers. If you're motivating with skewed or incorrect figures, it's stupid.
Or strategic.
Sure, if you want to play that game.
We would never do that,
No,
obviously.
But I mean, I can see what Manny's saying about something like the banks. They are pretty high level information because once again, there's metrics that you're reporting on. If you've got a loan or any of that kind of bank or anything like that, they will have items which is going to be pertinent to how they want to see it. But they'll want to make sure that your information's accurate and that you're a trustworthy partner to do the business with. So from their perspective, it's probably a little bit less warranted to risk against the bank, which is naturally conservative. They're very risk averse. So someone like me as an investor is more willing to take a little bit of risk and therefore happy with the materiality level to be a little bit higher versus lower for the bank. So
And so what do you think the banks want? What do the banks want to see? What do the banks want to know? What do they want to understand? Because the reason I've asked the people that are watching that are not listed companies being audited all the time, or not big companies being audited all the time, but next week might get an opportunity and might need to get money from a bank in the quickest amount of time, the shortest amount of time possible. Right? What should their business be ready to show?
I think fluctuations with smaller business such, there's fluctuations are far greater. So you could have an increase in revenue to 25, but that's going to hit cash flow and so on. So therefore, you are relying on the bank to fund that short-term aspect. So it's about making it apparent and knowing where these differences are and why it's happening. I think you can only tell that from the financials or the notes to the financials, along with you as a director or the owners stating why. But I think one is the transparency, probably.
Yeah.
It's one of the main things I would have thought.
Yeah.
yeah, there's probably every bank when they do issue a loan will look at the business structure and go, well, these are the pivotal points for this business. I mean, specific sets data that the bank will want, I think, is not going to be the case from one business to another.
No.
They'll all be tailored to the individual business. But yeah, I mean, they want to see trust and transparency. They want to see accuracy as much as possible. And yeah, you trust me out. Same thing with the bank, insurance companies, anybody else that needs access to these financial statements. But yeah, I mean, I'm able to manipulate these figures. I mean, they're to chop and change and manipulate. And revenue is definitely not the only course of action in which you can do that.
Oh, no, of course.
There's other aspects. Expenses.
What's that?
Yeah. Let me look at my notes.
Yeah.
Expenses.
Go on.
No.
Oh, you're the master of this.
No.
Refer to you.
I was only getting to that. If you look at a bank, for example, and investors' businesses, less so than ASX probably as well, is that you really want to understand the fundamentals of the core as they are, whatever they're to, right? And I think that a good set of financials, a good set of reports, right, will clearly identify what is the actual business versus what is either non-recurring or non-normal, or the fluctuations exactly that. And Manny's exactly right. The notes become critical, the understanding of the movement of cash flow, and I think equally more than anything is the actual working capital requirements of that, right? So the working capital requirements of the business, because everyone thinks that as they grow, it's just going to be a plethora of money in the bank account. But it is just not the case, right? It is so expensive to grow a business, right? And so debt plays an important role. right? And so when a bank is going to go and lend or give money, or an investor is going to put money, yes, they're investing in the idea, the people, the model, the everything, but at the same time, like, the business get to the level it needs to get to without the money, right? Whether it's debt, whether it's investment, anything, because it's just too. I mean, look, there's obviously unicorn businesses out there that are just so profitable that they can do whatever they want, at any time.
Yeah, but once, as you say, so profitable, but that never generally means net profit on the balance or the profit and loss statement. It's more reflective of the cash flow,
Yeah,
and more cash flow from operations.
Yeah.
That really to what the business is capable of, and early a lot of those businesses, especially something like your software and SaaS model businesses, which take huge hits at the beginning through R&D and investment spend. I mean, yes, they're under cash flow from operations. That's generally more in your investing arm, but still, you
It's a
won't
different model
see.
altogether,
You won't
right?
see a lot of cash revenue come
Yeah.
through initially. It takes time to accumulate and build. Though you may have a whopping great big revenue, which has not yet materialised through cash. But
Yeah.
yes, but then
because you've got to recognise the contract value in its whole.
but then also again, once again, those businesses, the argument, and this is where expense manipulation comes into it. You look at costing or expensing the item in its full in 1 year versus capitalising the cost, which is one way that decision that can be made in order to alter the financial statements and how they present.
Mhm.
So obviously expenses go straight on the profit and loss statement and decrease the profit, while you look at capitalising them, they go on the balance sheet and generally see that go on the cash flow statement anyway through the investing section. So
And interesting to say that is a lot of the time is based on and your ability, or either the accountant or the auditor's ability to state why they've done something. So exactly what you just said, capitalizing an item. Some people will capitalize it, but some people will, and some people won't. But as long as there's an argument based on why you reached it, most of the time that gets through the audit.
And generally, the accounting standards will kind of dictate some,
Base.
grey or baseline about where stuff should be. But every business is slightly different, right? Because that item is supposed to generate a future benefit, right? It's not about that moment in time when it's been bought, right? It's about you bought it, and then that is going to realise some value to the company over a period of time, whatever that period may be.
yes,
Right, so that's the whole point of, either the goodwill or the, depreciation asset or whatever the case may be.
well, I always think one of the easy examples you look at is rent. Would you capitalise rent?
Well, it depends if you're talking about right of use assets, which is a big thing now under
Yeah.
under the new leasing over the last few years, or rent of something else.
Once again, perfect example of why it can be a grey area, because
Yeah.
most people would sit there and go, oh, if the lease says I'm here for only 1 year,
Yeah.
then it's in the year, and the rent that I pay for this year is only going to cover this year, so therefore expense in its full entirety. But yes, the accounting standards has changed. I don't know, I can't exactly when that came in, you'd know better than me, but obviously that threw a huge curveball because it added onto the balance sheet.
Correct.
And one of the gripes I do have as an investor, with the financial statements and the differences between one company versus another, when specifically on this kind of things, I like to look at proper capital expenditure that a business undertakes. Obviously property, plant, and equipment, as well as intangibles, any intellectual property kind of stuff which they're investing in. So software R&D, you would generally put to capital expenditure because it's for a future use. You're investing in the business to grow. But when you look on the balance sheet and you look under, debts, for its sake, or liability in that regard, they tend to lump in the lease liability with borrowings, and then they rely on a note.
Yep.
And in some cases, they don't even rely on the note. So then it's pulling it apart and going, which is actually debt which they're using in order to grow their business, and which is just the rent that they're having to put on the balance sheet now, which is clouding the issue of actually how much debt does this business have. I mean, while yes, legally, the company has an obligation to pay their rent for the term of the lease, and that needs to be put on the balance sheet to reflect that. I get that. I get what the business is trying to do there. But I don't look at the rental as per se a debt. I look at it as bank borrowings as a debt, or something of that regard. I would look as a debt. I look at the rent as something different, a little bit more traditionalist, where I look at it as like, well, these are that will come up in future years.
Correct.
It can easily be managed by the profit and loss statement. Yes, okay, I know why they're putting it on there, but really, is it actually helping? I my point of view as an investor. Yeah,
But now if you're looking at like a right of use, right, where your whatever asset it is that you're leasing is now considered an asset and not expensed straight away, which means it's being impaired and depreciated, right? Which means that your EBIT and EBITDA, right, now your rent sits in a different side of the, or potentially considered a different side of the, which can be confusing for people. And I think more down this impairment and more than anything, is obviously we have to do our impairment of goodwill every year, right? And so something that can be really played with, right? Yes, there's formulas. Yes, there's specific things that you need to do, but there's a lot of stuff that is be done and is based on the internal knowledge of the business to determine what are the CGUs, which are the cash generating units, right? Where we are then impairing these individual units. How do we decide them? What do we pick? What's happened, right? And why did we do it, right? Comes down to really a discussion.
And judgment.
Judgment, exactly.
And that probably should have rethought about the initial question when you first asked me how is there manipulation from an investor point of view, and I think you've touched on the area which is probably prone to the most manipulation, because yes, while there are guidelines, I probably infer them as being more than clear-cut rules in terms of how to assess goodwill and any impairment that comes with it. I suppose I'm trying to put my auditor hat on here back in the days. How can you accurately assess the impairment of that asset unless you go through almost like a fundamental marketing campaign to assess? I mean, look, X now as well, you can make a value assessment, but it's, once again, it's an opinion. Valuation is not a science. It's opinion based. It's opinion that needs to be backed up with facts and figures and data, but it's still someone's opinion. And valuing, say, a building, which, let's be honest, can move very quickly from one year to the next, and especially in the last couple of years, we've seen massive growth within the property sector. To then argue, let's say it went the other way and we need to write down with an impairment, values in the eye of the beholder.
But this is why I say when you're doing, as long as there's a justification behind your number, generally it gets through. And that, and the investor is banking on whoever's prepared the financials has got the right idea or the right mindset that the figures are accurate.
And the more you've got to pull, the more ability to manipulate. So we talk about impairment of goodwill, right? You've got to determine the CGU, and how you're going to do that, right? Then you're probably going to do a DCF, discounted cash flow, right? Over when are you doing it based on that asset or the way you've determined the CGU? What's the discount factor?
Using DCFs pretty much day in, day out myself. You did that right for manipulation, because there's a lot of unknowns that you have to make assumptions on.
Exactly.
Any kind of business, right? Whether it's a business unit or part of a business or whatever, right? If you're going, say, 3, 5, or 7 years, right, in terms of a DCF, well, most people go 5, right, as a probably, but depends on your business, depends on your industry, depends on the cycle, and this is agriculture, there's income averaging and things like that. So of course there's some cycles that are longer than others, but really, right, you don't know what 5 years looks like. Look how rapid the world changes now. Look at the political risk. Look at the technological risk. Look at all stuff. So no matter what you do, right, you don't actually know. It is purely, that the auditors you're convincing of, right, or are agreeing to because it's commercially acceptable, right? But that doesn't mean it's real.
Once again, this is where, obviously I look at the impairment of goodwill as the example. Obviously that's brought in order to mitigate companies just keeping overinflated assets on their balance sheet. Now, if you're investing in a company that's not looking like it's doing its cash flow and profit and loss statement, but you're seeing a very, very strong asset-heavy balance sheet, then you should be asking questions. Now, obviously, some people don't put in that time or effort. Some people kind of do over these things. I mean, obviously, it plays the levels and risks to how they want. That's part of taking on that role, that you need to take responsibility for your own decisions. But yes, I can appreciate why they brought the idea or the standard in, and the idea and the spirit behind it. I'm just feeling like this is just brought in another grey area which while it is helping, I don't think it's all the way fully baked to making a final definitive decision, and I don't think you can. It's almost like that set of rules in a sport where it's just, well, was it in, was it out, whose fault is it, umpire on call, and everyone just has to live with it. So long as it's not blatant or willfully trying to manipulate, then yeah, but that's the thing, it can happen. That's definitely an area to be right. You'd like to think that if they're not 100% accurate, which, like I said, I'm not arguing they'll ever be, but at least reality kicks in, and let's say it was $1 million down on an asset when it should have only been 990. We go, well, we know the direction the speed it's travelling, so who cares? We're splitting hairs here. That's open.
And so all of the accounting standards are set up so that shareholders can't be tricked, essentially, right? And the ATO and all that sort of stuff, and guidelines to make sure that financials show the right. No one can really take the piss, if you will, right, of either clients or or maybe, right. So do you think some of these practices should be pushed into the non-listed, non-audited businesses? Should our smaller clients, that are operating, should be trying to keep perspective on some of this stuff every year, like get a valuation done more regularly to understand where they're at, or depend on ambition? Does it depend on the type of business, or?
They should, yes, but for me, cost is probably a heavy burden on some of the SMEs, where they'll look at this and say, I could better spend that 4,000 or 5,000 or whatever it is to do it, versus the audited clients, they have to do it. There is no choice. So they're obliged to go down that road, whereas the SMEs would go, well, I'm not obliged, so sorry, I'd rather save that from my own back pocket.
Do you think that does them an understanding the total for their business?
Yes, it does, but they're not looking at that picture. That for them, they've still got the blinkers receptive, is the way I'm going to put it. Because for them, if they don't have to do it, they won't do it, irrespective of what the accountant tells them or anyone else, because they're under no obligation to do it. It's with it. If you're not under an obligation to do it, why would you pay to get it done?
I think that raises a good point, because the smaller obviously get squeezed more. In most cases, get squeezed more than the ASX businesses and listed businesses, because the listed businesses and bigger businesses that are taking on private investment and things like that, even if they got losses, they've generally either got cash flow or are on a pathway to getting cash flow, right? So they don't feel the burden of overspend or of things as much as a smaller guys will do. Not always the case, of course. Listed businesses and that go belly up just as much as anyone else. But from a point of view, if you report a loss and not feel the cash burden so much, then you'd be more interested in innovation, more interested in spending money on these type of things, whether they're required or not.
Yeah, well, I suppose when we talk about the argument of an SME versus your big boy in town, and reporting, I
Get them down the right path that's going to work, but fundamentally, if it's the wrong place for them and they're not happy and therefore underperforming, so we're not happy, removing someone or someone resigning is a good outcome for both, right? Everyone looks at termination or looks at people resigning or looks at the staff turnover as a horrible thing, right? Staff turnover can be a horrible thing, right? But if you do what we did in the last year, where we've grown very quickly, right? We've done a lot of things. We've brought in people that have come from vastly different environments, right, in the different firms that they're working at. There will be fallout from that, right? If you're a one business that is stationary and doing the same thing all the time and you have massive staff turnover, you got some shit managers. Right?
There's a different.
That's a different thing. But when your business is evolving, when you're innovating, when you're changing, when you're moving, right, people aren't going to always want to come along for the ride, right? And they're going to be resistant and they're not going to enjoy it. And the best thing for that is for both of you to part ways. Right, and find someone else that fits with where you want to go. That is just a non-negotiable. But people are too scared to do that because they think that, well, I'm going to negatively affect somebody.
Well, I'd actually probably argue there is that element, the people's social impact element, the cultural element, what are you signalling to the rest of the team as well when you're doing these things. But I actually think a lot of businesses hold back purely on the financials. This will hurt my cash flow. This will hurt that.
But they're also scared that it's going to impact their own workflow. So if I remove or have to replace them, I have to do their portion or someone else has to do it.
I agree. That's another facet to it as well.
I think this is also as you add depth to a business, right? And where you then have in a small business where the directors are generally involved in everything, and then you get bigger and the team gets bigger, and then you have a layer of management and then a layer of executive, and then perhaps there's multiple layers of management and things like that. There's always a mechanism of self-protection, right, in that. So when there's things that are going wrong and you've got a bad staff member, but you need the work done, right, then some managers are still like, well, I need to make sure my numbers are right, so I can't lose people, right, otherwise my numbers are going to drop or something is bad. And so the financials then overrun the fact that they shouldn't be there in the first place.
Yeah, then a
right?
poor decision is made to just
Yeah.
deal with it, and we'll keep on muddling through rather than going, let's take the short-term pain in order to get a better outcome down the track. All this conversation, I suppose, getting back to our year of disruption and how disruptive it has been from the numbers perspective. As the investor hat person looking at it, I'm looking at it going, if this was a business that was, as you say, stagnant, the incumbent, the big player, the blue chip, whatever you want to call it, and I'm just purely looking for a simple return, this would be troubling. But it's more of a case that I'm looking at this going, no, we've spent time and money, which has been shown up on our financial reports. It has hurt us in a way, but I actually look at it now going, we have now cleaned the slate of the business to have a solid foundation to go to that next level. This next period can be a lot less disruptive because we've taken the time and the pain in the short term in order to get it to where it needs to be. There's not a stone which is hiding an issue which we're just ignoring. It's everything's been cleared, everything's been turned over. We know what happened. We're being self-reflective enough to say, that hurt. We're looking to do better, but at least we've got the foundations to go to that next level. So that's how I'm approaching it.
Do you think that, because there's a conversation here to be had about, I see a lot of business owners, and I've seen this through our client base, some here, some no longer here, some whatever, sold, etc. Early greed, start a business, and now with social media and all of this, right, it is only doubled or tripled down on this need for a lot of people to say, I've started a business and now within 12 months I drive a fucking Mercedes, right? But when you're talking about what you're saying, right, the reason you're looking at it from a different point of view is because you're looking at a business, and this one in particular, the same way Manny and I do, is go, well, this is something that it's a long-term decision, it's an asset that we're building, right, and it comes with long-term benefits. So I would rather wait than strip out anything early and sacrifice, well, what it could be.
Once
right?
again, we're now delving into the psychology elements of it. I'm not sure.
This was can I break it down?
Oh, sorry,
Manny,
I need to put my head in Manny's lap.
Manny, why are you stressed? Manny?
Is it because he's not humble enough?
Yeah, it's,
Carvey, am I humble?
Just like the button on your vest.
she shakes her head.
Turn the camera around.
Yeah.
That's all right, what are you telling us? Oh, no, Carvey just put a note up, that's all. It says, you three look handsome.
Where was I going?
Psychology,
Fun of
psychology.
investing in business. Once again, not everyone's built for business. Not everyone's built for investing. Not everyone's built for
Does
multiple different things in life. We can't all be amazing at everything. Wow. I can just see the number count on our viewership just going down.
What an asshole. And that'd be right.
Blood noch.
Sorry.
I lose brain cells just as much as viewership.
What is it, sorry?
Blood noch.
No, subscribe. It should be you. I'm not taking that off you. That's your job.
I feel like you're trying. I feel like you're going, you know what, I could do this bigger and better.
No, I can't overshadow you anymore.
Do you even have a shadow?
No, I'm a vampire. No reflection.
Look, I think it gets down to the psychology of who you're talking about. Some people should be in business, be owners. Other people maybe can learn it. Others definitely not. And I suppose it all comes... I always think of that delayed gratification test that the social science geniuses concocted, where it was like, you put a jelly bean in front of the kid and, okay, well, if you leave it there for 10 minutes, I'll give you 2. And you see the ones that do leave it and the others that are, as soon as the scientists out. And it's like, it's hard to teach to be patient. It's very innate.
We just had this conversation earlier.
But going on to your little social media element rant, I do think there is a lot of pressure targeting people to think very counter that narrative. So yes, those of us that are somewhat susceptible to being convinced, don't wait. Go buy that thing that you've always wanted. You only live once.
Yeah.
Oh, sorry, YOLO, I should say.
YOLO.
Is that still
Can't-
relevant?
can't
It's probably
reprint
not.
it. Yeah,
no more YOLO, no more YOLO.
Sorry, scrap that. Sorry, Gen Z.
Sorry.
I got it wrong.
He was getting it right when he was in his 50s.
Can I have my cane? I feel like walking out. So yes, I take your point on it, but genuinely greedy people that just want me, you should avoid the plague, irrespective of whether they're in their own business looking for investors or they are the investor wanting to invest. They are so wildly detrimental. Somebody that can sit there and understand that if you're investing in a business, there's a time, there's a place, there's a journey you've got to go through. You can't just go, day one, $1 million, thank you very much, move on. You know, it's just going to kill it.
And I think resonate with this. The people right now, or some business right now, they would have had great growth and so on in the COVID times because certain demographics done well in that sector. Now everything's normalized to a certain degree. Now they've realized the normality and they're going back down to normal, and some of them are closing shop or they're shutting down or so on because they've not been able to either innovate or change with the times as such because they're used to what happened back in COVID.
Right.
I'll give you a prime example of that. Zoom. Corporation.
We've spoken about this.
I've probably one of my biggest faux pas in terms of investing. I thought I invested when it was on its way down and hitting a plateau where I thought this is a very strong cash flow heavy business that has the ability to invest, to innovate, to change, to become something beyond the COVID plague.
Yeah.
Too early still, and obviously have regretted that ever since. And yeah, the business, unfortunately, even with its cash flow generating abilities, are trying all new things, and there still doesn't appear to be much light at the end of the tunnel. So it can even happen to the big players.
Yeah.
And I agree with you wholeheartedly.
And let's address a little bit there, kind of that I've put in front of us right now, where we're talking about one of the things that I think is one of the most important attributes for, you know, or a director or entrepreneur, whatever you want to call yourself, being patience. Then I've also said speed, right? And so now we're talking about, well,
You're talking about the timing,
Yeah.
not drug to make you faster.
yeah. Well, we only do that.
I'm not
3 out of 5.
condoning, I'm just getting it right.
Yeah. If you want productivity, like it's that'll be his job now.
I can't beat the humble.
No, but I think that when I talk about patience, the point that I want to make is that when I talk about patience, and you'll both probably, well, hopefully agree, is that patience is about having an ultimate objective that is quite grand or quite, everyone wants to make a big business, or not everyone, but people that want to make a big business or want to grow something, or they have ambition and want to drive and do stuff. Patience is about the long game. When I talk about speed, I'm talking about all the little shit that happens throughout business on your daily, weekly, monthly, quarterly, you know, right? There's a good argument to say that if you try to analyze every one of the decisions you've got to make properly, right, you're going to screw up your business.
Yeah.
You've got to go with gut a bit of time and just move quick, right, on small things where it's like, okay, this process, maybe this software, maybe this, you know, maybe
I
this,
do agree with that.
you know, this group, this client. Do we get rid of this client? It's going to cost us because they're a big client, right? But they're costing us in resources,
by the
right?
time
And then,
you come round to making a decision with full clarity,
yeah, it's too late.
it can be too late.
Yeah. So is it better to be too late on everything or too fast on everything?
I think that's a skill in understanding how and when.
I think what I've seen probably since COVID a lot, what hinders that is ego. So people got growth
we wouldn't
very
believe that.
quickly.
And our next podcast,
Yeah.
ego in your business.
Yeah.
Do you have someone killing your business?
How to be humble when you're in first class.
I was waiting.
A shift in economy, I don't know.
I don't know. I've got a sharpened toothbrush anyway, just in case.
Good. That was good talk.
Yeah.
Good
Probably a good spot to leave it.
Yeah.
No, I don't want to take over your job. Been encroaching
You're-
mine. Maybe I should.
You've moved to the co-host.
Oh, yeah.
I have stepped up.
What?
What was that, darling?
I don't think we
I
should.
really want to say it.
He's prettier than that.
I really want to say it.
It was under Carver's instruction. Let's put it at that.
Yeah.
Leave it at that.
Yeah. It rhymes with reversity.
We have a really strong alt-right following. Glennoch, the alt-right in you.
Gonna put lead in your pencil.
Thank you, everyone.
Thanks, everyone. We'll see you next time, where apparently we're going to be talking about ego in business and how it's going to ruin your life.